Recently, I had to explain the cryptocurrency market to a beginner who happened to be a legal advisor and was interested in buying Bitcoin. At the same event, which happened to be a kid's birthday party, I showed another dad how to buy Ethereum. So, in today's podcast episode, I am telling that story and what we all learned from it. For those of you who are new here, I am Jim, a 45-year-old former professional gambler who's now a solo web entrepreneur creating content and running websites for a living. For over a decade, I made my money in the high-stakes world of counting cards at blackjack tables, betting on sports, and playing online poker, while also dipping my toes into the fast-paced world of day trading in forex and stocks. Today, I have left the gambling behind, but the lessons I learned at the tables still shape how I approach life and business. So, due to my background in gambling, friends often come to me when they want to talk about anything related to gambling. A few days ago, at a birthday party with friends and parents from my daughter's school, cryptocurrencies and Bitcoin came up. One of the dads, who happened to be a lawyer and legal advisor, let's call him Jason, had zero knowledge of the cryptocurrency market. At the time, I was showing another dad how to buy crypto at the party. Quickly, an exciting conversation started between the three of us. Jason bombarded me with questions, giving me the perfect opportunity to hear what a true beginner in crypto would ask. In this podcast episode, I will go over many of the questions I received, along with some interesting points raised by the other dad, let's call him David, who was more familiar with crypto and was looking to buy Ethereum. But first, as always, I want to make clear that everything I'm saying today is based on my personal opinion and experience. I might say wrong things, and none of this should be taken as financial advice. As expected, the conversation began with a fundamental question of what cryptocurrencies are. David was eager to explain the theory behind cryptocurrencies, but he quickly realized that Jason, being a complete beginner, wasn't going to understand the crypto jargon and terminology that easily. So, I stepped in with a much more familiar example that we all know: stocks and the stock market. How do you invest in stocks? I asked him. How do the prices of a company's shares go up or down? Well, cryptocurrencies work in a similar way. And don't forget, it's all a gamble. Cryptos are gambling. Stocks are gambling. Wait, Jason interrupted me, as he was indeed more familiar with stocks, due to his legal background. In the stock market, when I buy a stock, yeah, I know, I interrupted him back. Something is backing the stock: balance sheets, products or services being sold, a workforce, revenue, etc. Exactly, he said. When a company wants to raise capital, it goes public with an IPO. If I'm interested, I buy some shares, and with my money, I am purchasing part of the company. I become a shareholder, he said. Exactly, I responded. Let's start with the IPOs that you know, because that's basically what ICOs are in crypto. Let's say I have an idea to build a smart swimming pool, I told him, since we were at a water park. I need money, but I don't want to deal with the Securities and Exchange Commission, regulatory bodies, or financial institutions. So, say I decided to create the MACOS coin. Whatever money I raise from the ICO, I will invest in my idea. If you like my idea and trust that I won't take the money and disappear to another continent, you can buy some MACOS coins, like you would buy shares in a company that's just gone public. Yeah, but hold on, Jason interrupted again. With companies and stocks, there's a company behind it. What's behind this? In this case, for my coin, I said, it's just an idea. Essentially, it's hot air. Maybe if I had built something beforehand, there would be some proof or infrastructure, like there is with Bitcoin or Ethereum, I explained. And that's how we slowly eased into the cryptocurrency market. After all, Jason wasn't interested in learning about unknown sketchy coins. He had only heard of Bitcoin and Ethereum, and that's what he should stick to anyway. When it comes to Bitcoin, I told him. You can read the white paper online to understand the theory behind it. Personally, I'm not great with theory. I have yet to read a single page of that white paper, but that didn't stop me from following Bitcoin's rise since I first heard about it, back when it was trading around $400. If you want to know what Bitcoin is all about, you can start there. Just like you would start with a company's mission statement or business plan. At that moment, David re-entered the conversation. Since he finds Ethereum much more interesting than Bitcoin, he explained to Jason that while Bitcoin is somewhat intangible, Ethereum has practical, real-world applications. This led to a quick comparison between the two cryptocurrencies, and I added, if Bitcoin is like gold among commodities, which I assumed Jason would understand, then Ethereum is like silver. As we were explaining the difference between the two cryptocurrencies, the word blockchain came up. What is blockchain? Jason, being a lawyer, pointed out that with stocks and real money, we know who is buying shares, and the flow of money is recorded. So, what happens with cryptocurrencies? David immediately defended the traceability of cryptocurrencies. From the moment a single crypto coin is created, its entire path is recorded on the blockchain, he said. And that's the truth. I explained that on the blockchain, all transactions made with a specific coin are recorded. That's why each coin has its own blockchain or is based on Ethereum's one. The difference between the real economy and the banking system is that this blockchain exists freely on the internet, and you can even download it yourself, I told Jason. In fact, if your computer meets specific requirements, you can connect to the blockchain and become a node, verifying transactions. But that sounds advanced for now. At this point, Jason was already lagging behind a bit in the conversation. What do you mean by from the moment the crypto coin is created? Jason asked. And that was the perfect moment to explain what cryptocurrency miners do. Since I have never been a miner myself and haven't delved into that part, I told him whatever makes sense to me. Miners, as I understand it, are the ones who verify transactions. So, for example, if I send one Ethereum from one crypto wallet to another, it needs to be confirmed by several nodes before the transaction is complete. Miners are responsible for these confirmations. Depending on how many confirmations are required, the transaction can either happen quickly or take some time. Miners earn a fee for their work, so if you want your transaction to be faster, you will need to pay a higher fee. The fee amount also varies depending on the blockchain. Additionally, these verifications require significant computing power, which is why you have probably heard about people building rooms full of powerful graphics cards or setting up in underground caves to keep temperatures low since the GPUs run at full capacity 24/7. Ah, Jason said. So the price of a cryptocurrency is backed by something, the cost of the energy consumed by these graphics cards. Yes, you could say that, I replied. To create a cryptocurrency, energy is required in the form of electricity. But why is electricity and computing power needed? I asked him. When the first Bitcoin was created, the computer had to solve a simple equation. I continued, answering my own question. Let's say 1 + 1 = 2, and that's how the first Bitcoin was mined. The next equation was a bit more difficult, but still relatively simple. The more Bitcoins that are created, the harder the equations get. After all these years, the algorithm, or the problem that computers need to solve, has become exponentially more difficult for each new Bitcoin. Okay, Jason said. So once you have created a Bitcoin, where is it? Well, I said, when a miner gets paid for verifying transactions, they are paid in the cryptocurrency they are verifying, or at least that's how I understand it. Anyone can create a wallet, which is like having a bank account number or IBAN in Europe. That wallet becomes part of the blockchain. So let's say I create 10 wallets on the global cryptocurrency ledger. Those wallets, just a series of numbers and letters, exist on the blockchain, which everyone can access. These wallets could be on your hard drive, a USB stick, or even a piece of software. You can use them to store, send, or even pay for services that accept crypto. And your name isn't shown anywhere unless your purchase can be traced back to the exchange where you deposited money from a real bank account. That's why buying or selling cryptocurrency over the counter is preferred for anonymity. And to keep it totally safe, you should hide your IP, have a dedicated machine only for crypto, and never connect that machine to the internet. So who gives me these cryptocurrencies? Jason asked. David said you helped him buy Ethereum. Who gave him those? Well, who gave you your stocks when you bought them? I asked him in return. Hey, wait a second, Jason replied. When I buy stocks, I send real money and get shares. Hold on a minute, I interrupted. What real money? Those are just numbers on a screen. We live in a virtual reality where we simply move numbers on screens to get things or services that aren't always physical, like cloud storage or streaming services. Even with stocks, you send a number from a bank where you are paid electronically for legal services. And in return, you get a piece of paper saying you own a percentage of a company, which might not even exist in the future. That's why I always say that all of this is gambling, I continued. Sure, you can read the financial statements, see what a company is trading, and assess its business plans for the next decade. If you trust them and believe in their product, you can become a shareholder. But even then, that's still a bet. You are betting that the company will do well and continue to sell its product or service. But it could just as easily fail. So, it's all a gamble. So, who sold David the Ethereum he bought? Jason asked again. Someone who was selling, I answered. Wait, David jumped in. What do you mean someone who was selling? I bought it from the cryptocurrency exchange. The exchange gave it to me. I laughed. Do you want to hear something that might stress you out, David? I asked him. Right now, you don't even have Ethereum. You don't have anything. The only thing that's certain is that the euros you sent from your bank account, which by the way was a digital wallet, went to the exchange's bank account in euros. No conversion happened. There is no Ethereum. The only real transaction that happened was that X euros went from the digital wallet's real bank account to the real bank account of the cryptocurrency exchange. You will only get Ethereum once you transfer it to a hard wallet, one that you own, I explained, turning to Jason, like a USB stick. That reminds me, David said, launching into a story about a documentary he watched where the owner of a cryptocurrency exchange was found dead in India, and no one actually believed it. Yeah, I said, that's a well-known story in the crypto world, and that's one of the biggest risks, I explained to Jason. Because cryptocurrencies are still mostly unregulated, there is always a risk that an exchange could go bankrupt, and you'd lose your money with no guarantee you'll get it back. But similar stories have happened in the stock market, where millions were moved around in Ponzi schemes. The cryptocurrency market is still in its Wild West phase, but rules and regulations are slowly coming in. However, the safest way to protect your money is to transfer your crypto into a hard wallet. As we say in the crypto world, not your keys, not your crypto. Meaning, if you don't have the keys to the wallet where the crypto is stored, it's not really yours. Jason then asked, So who sets the price of Ethereum? Well, what do you mean? I replied. The market, supply and demand. Just like with stocks. No, Jason said. With stocks, there are revenues, profits, and sales. Although now stocks have become more of a game, especially with derivatives in secondary markets. Aha, I said. You are getting to my point. See? It's all a gambling. A company starts with an idea, and that idea becomes a product. Then we create bet after bet on that product. People love gambling. They love the idea that they can make money from thin air. There is a demand for it. So the financial institutions jumped in to meet that demand. And of course, they take their cut. Commission always wins. So, the price of cryptocurrencies is determined by supply and demand, I continued. It's all a psychological game. It's a war of emotions. Hold on, David interrupted, having just bought some Ethereum a few minutes ago. It's not like that. I could sell my Ethereum right now for double the price. Yes, you could, I said. You could go out and say you are selling it for 4,000 euros instead of the 2,000 you bought it for. But who's going to buy it from you? Who's going to take your offer when they can get it for 2,000? Why did you decide to buy it at 2,000 and not when it was 3,000? The answer is simple. For everything, there is a price that the market sets at any given moment based on supply and demand. And how does the price go up? Jason asked. The price goes up, I explained, when a large fund managing millions decides to invest some of that money in Bitcoin. Let's say they want to buy 10 million euros worth of Bitcoin at 50,000 euros price, but there is only 1 million available at that price. Once they have bought that, they will ask for more at 51,000. They will buy 2 million more, then the price goes up to 52,000. By the time the demand is satisfied for 10 million euros worth, the price could be up to 55,000. Will it stay there? Who knows? It depends on the psychology of investors. If they think it's expensive, they will start selling. If they think it's cheap or they see the fund buying more, they might buy as well, pushing the price even higher. Yes, Jason said, pointing to his beer glass. But this glass of beer costs €1. That's a real, tangible euro. Wait a second, I replied. What real euro? The one that in 10 years, due to inflation, will only buy you half a glass of beer? Everything is relative. The only certainty is that if I have an apple, I can trade it for an orange. They are two tangible things that we can exchange. But even in some countries, an apple might be worth 2 oranges, or the other way around, depending on which fruit is favored by the climate, which is harder to grow, and how many apples and oranges are in the market. Once again, it all comes down to supply and demand. Wrapping up the conversation with David, the engineer, and Jason, the lawyer, I emphasized the level of risk involved in cryptocurrencies. Speaking directly to Jason, a crypto beginner, I compared crypto to other markets and investments he was likely more familiar with. If I were you, I said, I would first invest in real estate. Buy your first home if you are renting. Then I would move on to government bonds. After that, I would take a little more risk with stocks. And with whatever money I had left, purely for investment purposes, I would put maybe 2% into crypto. That way, if it skyrockets in the future, I will not have to kick myself for not having at least put €1 into it. As for David, who had just bought his first cryptocurrency, I didn't have anything new to tell him. I gave him the same advice I gave my friends back in 2017, when they were buying Bitcoin for the first time. Buy it and forget about it. You are going to be constantly checking the price now, David. You will want to look at the chart every day, every hour, every minute. When it goes up €1, you will wish you had bought more. When it goes down €1, you will start thinking about selling. Can you go without looking at the chart for 10 years? That would be the best thing to do. That's what I said back then, and that's what I'm telling you now. And I will tell you what my friends told me years later, friends who didn't listen to me in 2017 and ended up buying and selling not just Bitcoin and Ethereum, but all kinds of cryptocurrencies. Jim, even though we made money, we would have made 3 times as much, or even more, if we had just done nothing. That's because people find it hard to sit on their hands. They are itching to gamble. And while gambling and betting are popular topics, and I was once a professional gambler making a living counting cards in blackjack, trading on betting exchanges, and playing poker, I avoid talking about gambling for several reasons, which I have explained in a recent podcast episode. But for now, I will say this. When all Dutch have bought Bitcoin, David should have already sold his Ethereum.